Hello there. Gold price has increased by more than $600 since February this year. Wouldn't it be nice if gold miners were to catch up and overperform versus gold price? Talking about miners, let's have a look at fundamental valuation for these three majors: GoldFields, AngloGold Ashanti, and Kinross. This valuation is based on their Q2 reports. What we're going to do for these miners is look at their discounted per share value after all-in sustaining costs, long-term debts and taxes. We're going to look at cash as well, although it doesn't go into the valuation model. Instead, we'll look at cash as just an additional way of assessing risk. So the valuation factors that do go in our model is, of course, gold price, the amount of reserves and resources that the miners have in the ground, all-in sustaining costs, the long-term debts, taxes. We'll look at per share value as well as time value of money. So we apply discounting based on average mine life, a bit of insider sauce, and cash as just another way of looking at risk. Moving on to reserves and resources in the ground, GoldFields has the largest endowment of precious metals. That's 43.7 million ounces in gold reserves, that is proven and probable reserves, plus over 30 million ounces of measured and indicated resources. GoldFields has nearly 42 million ounces of silver reserves and just over 2 million ounces of silver M&I resources. They also have 336 million pounds of copper reserves. Next up is AngloGold Ashanti with nearly 27 million ounces in gold reserves and nearly 60 million ounces in gold M&I resources. AngloGold Ashanti has quite a lot of copper as well, at over 3.2 billion pounds in reserves and 2.9 billion pounds in M&I resources of copper. Next up, Kinross at 21.7 million ounces of gold reserves, 26 million ounces of M&I resources of gold, 23.7 million ounces of reserves of silver, and 34 million ounces of M&I resources of silver. Beyond that, they all have inferred resources, but those are not included in this valuation model. We'll try to model the value of those endowments in the ground for three scenarios, with the balanced scenario plugging in the gold price of $2,300. Our conservative scenario plugs in the gold price of $2,000 per ounce, and the optimistic scenario only goes up to $2,600 per ounce. As you see, with the current gold price above $2,500, even our optimistic scenario is somewhat conservative. In general, as I mentioned, we do like to lean towards the conservative side. After all, you don't want to be too emotional in your investing activities. By the way, for rational investment ideas, make sure to join us at myfinanceteacher.org. As you see, the members get early access to the details on much more gold and silver miners, both among majors as well as some most interesting juniors. And myfinanceteacher.org has the best nickel as well as uranium reports on the internet. By the way, the next uranium report is probably going to be published somewhere around mid-September. There's been a lot of interesting developments in the nuclear industry. Moving on to costs, debts, taxes and cash, GoldFields has the highest all-in sustaining costs, hence the smallest margin, hence the largest leverage, with all-in sustaining costs at $1,595 per ounce. This is the midpoint of their 2024 guidance. They have $1.2 billion in long-term debts. For taxes, I simply assume a 25% flat tax to simplify and speed up the process a little. GoldFields also has about $400 million in cash. Remember, cash is not included in the actual valuation model here, but serves as an additional measure for how much risk there is. Remember the example of Goldcorp, previously the largest gold mining company in the world, which got into trouble with a little too much debt and not enough liquidity. Moving on to AngloGold Ashanti, their all-in sustaining costs are at $1,550 per ounce. They have more than $2 billion in long-term debts and nearly $1 billion in cash. Kinross has the lowest costs here at $1,360 per ounce. They have about $1.25 billion in long-term debts and about $480 million in cash. Next, moving on to shares outstanding and time value of money. GoldFields is at nearly 900 million shares outstanding. AngloGold Ashanti is at nearly 420 million shares outstanding, and Kinross is at 1.23 billion shares outstanding. Insiders are not holding a large percentage of those shares outstanding, only between 0 and 0.3% for these three large miners. Extracting the gold, silver and copper reserves out of the ground will take time. Based on the current annual production for 2024, proven and probable reserves will last for around 21 years for GoldFields, and if you add half of their M&I resources, the average mine life extends to 28 years. AngloGold Ashanti has 10 years of proven and probable reserves. Adding half of M&I resources extends the average mine life to 21 years. And Kinross has around 10.5 years of reserve life. Adding half of M&I resources extends that to 17 years. And as it takes time, we need to take into account the time value of money, where I use the discount rate of 7%. As I mentioned in the most recent video, for the Q2 reports, I've increased this discount rate a little from the previous level of around 6.5%. By the end of this year, perhaps I'll reduce it a little if the Fed drops the Fed funds rate as expected. Next, moving on to the exciting parts, the valuation results. The conservative valuation plugs in the gold price of only $2,000. With the current gold price above $2,500, think of it as one measure of risk level, what could happen to share prices if gold price just drops out of bed here. We see GoldFields at over $7.30, AngloGold Ashanti around $16.20, and Kinross at about $5.40. For the balanced valuation, we're going to plug in the gold price of only $2,300. That's a couple of $100 below the current price. And even in the balanced valuation, we're only looking at proven and probable reserves in the ground, without taking into account any of the M&I resources, never mind inferred resources. That brings us to over $13.10 for GoldFields, over $28.70 for AngloGold Ashanti, and over $8.20 for Kinross. Lastly and most excitingly, looking at the optimistic valuation, which is still, you might argue, quite conservative, as even our optimistic valuation plugs in the gold price of only $2,600. And in this case, look at the value of proven and probable reserves, as well as only half of measured and indicated resources. After all, these are less certain than the P&P reserves. Still, we're dropping half of M&I resources, never mind any of the inferred resources. And that brings us to about $23.50 for GoldFields, around $69 for AngloGold Ashanti, and around $16 for Kinross. I really wouldn't mind seeing these prices once gold confirms its intention to stay above 2,500 and successfully reaches this next target at 2,600. Currently though, the current share prices are somewhat above the balanced valuation, but significantly below the optimistic valuation. That suggests that with these assumptions for the tax rate, discount rate and so on, these major miners are currently pricing in a gold price of around $2,400. So even with the most recent run-up in miners as they are catching up with gold, there is still some distance left to catch up for these majors. So that's over the last couple of months, but tell me down in the comments below, what do you think will happen into the end of the year? Will miners outperform gold, providing for a Christmas present? Again, let me know down in the comments below. Have a great day. Bye bye.